Okay, let's start. So, good morning, class. So, you're welcome to week 9. So far, we have looked at several topics from regulatory framework, which is where we started, down to conceptual framework. Then we moved on to IS1 on presentation of financial statements. And even before we moved on to that IS1, I emphasized the importance of regulatory framework and conceptual framework. I told you that you always find it in your exam every night. There's nothing we can do with that. So it's extremely important. Like your mock exam today now, you find a lot of it there today as well. And we then looked at IS1. What we achieved in IS1 was to set the ball rolling by looking at the structure and the content of a financial statement. After which we went on to IS16, which is property, plant, and equipment. And we spent a lot of time there trying to teach you how to calculate depreciation, how to determine carrying amount, and I gave you several assignments and we solved several questions in an attempt to get used to it because it's going to form the bedrock of most other things we are going to be doing in this class. Like what we are having today is also sitting on principles like that of IS 16, and going forward you will see. Then we went on to IS 38 that deals with intangible assets as well. That didn't take us so much time because, of course, it has almost similar principles with that of IS 16. And on that basis, we are now half of the diet. Now we have like around this the ninth week. We are going to week 17. We still have a lot of work to do, but at least it's going to become easier, not as difficult as before. Now today, what we want to look at is IFRS 16 on leases. You see, the context here is this, is that an entity needs an asset. They need an asset, but they don't have the immediate financial resources to acquire that asset. You want to buy an asset that would enable your business for, let's say, 50 million, and you don't have that 50 million, then you look for an opportunity whereby you can still get the assets, but you can pay instrumentally, right? Like rent. You look for opportunity to rent. And in some instances, the entity could have the money, but they just want to manage their cash flow. That why should we go and outlay this so much money if we can get an opportunity for us to rent it? So this IFRS 16 on leases is more like a cash management technique for most entities. And you see, this idea is where we are trying to move to in Nigeria. We are trying to develop a credit economy whereby, as a young graduate or a young person that is just starting out in life, you don't have to look for 20 million naira to drive a good car or 15 million naira to drive a good car. You could have an opportunity whereby a system will just tell you that, okay, can you just contribute a capital of 20%? Then you can pay the remaining over 20 years, over 25 years. You know, it makes life easy for you. Or you want to have a home, you are just starting out with a family, right? And you are looking forward to having a home, you can key into a mortgage scheme whereby you do a down payment, then you pay the remaining over a certain number of years. Most advanced countries, that's why they continue to advance. That's why there is economic growth, right? Because they are on a credit system. But here we are not there yet, because even if you want to key into that credit system, the interest rate is so high that you don't even want to go there, and it's affecting growth, right? You see, that context is what IFRS 16 is looking at. That businesses does not need to outlay so much money to buy an asset. They can rent it. They can pay a small amount and spread the remaining over many years. And that is the main idea behind IFRS 16 on leases. Now, with that context explained, now let's look at the way IFRS 16 defined leases, then we can take it up from there. So let's start with the definition here of leases. IFRS 16 says that a lease is a contract that conveys or that transfers the right to use an asset from one party to another in exchange for a consideration. Now, this definition is just conveying what I've just explained to you. But the key thing here in this definition is that a lease is a contract. That's the first thing. There must be a contract in place. That's extremely important. So when we talk about lease in the context of IFRS 16, it has to be a contract. And a contract is an agreement between two persons or more that has legal or economic consequences. Meaning that if one of the parties do not fulfill his own part, there could be legal consequence, there could be economic consequence. Therefore, a contract need not be in writing, but it must have legal or economic consequence. What is important is that the party must do what they are supposed to do. If they don't do it, there are consequences. You don't have to be in writing, right? But a lease is a contract. Now, you see, this contract, what it will show is that it's basically transferring the right to use an asset. Right to use an asset from one party to another party in exchange for a consideration. Now, you can define it however you want to. What is important for us in IFRS 16 is that we should be able to identify a lease in a contract. That is, if we pick a contract and we look at the content of that contract, you need to know that this is a lease and this is not like a normal purchase arrangement. Let me give you two scenarios. So, if what you do for business is that you do delivery, then you deliver from, let's say, your office in Aja, deliver all over the states, right? Let's say within Lagos, Mushin, Isolo, Magodo, and all of that. So you decided that why not just have your own truck that you can be using for delivery, but you don't want to outlay so much money. Then you went to a leasing company that can you give me this truck for, let's say, 2 years. I want to lease it for 2 years, similar to what we call hire purchase, right? That is lease is hire purchase, right? Before now, what we used to have is hire purchase, accounting for hire purchase. But since we adopted IFRS, we don't call it hire purchase anymore. What we call it is now what? So what I'm talking about is hire purchase. So you went to pick up the truck and say, okay, I want to lease it for 2 years and I'll be paying you 50,000 naira per month. Yeah, agreed. You took the truck to your warehouse, then you started using it for your business, right? That's scenario one. Of course, you'll have signed a contract and all of that. The second scenario is that you, the same business, instead of going and saying you want to leave, you went to meet him that, guy, can you please help me deliver my goods whenever I need to deliver, right? So at every point you want to deliver, you simply pay him for that delivery. You see, those two transactions are extremely different. While one is a lease transaction, the other is just a normal service that the guy is rendering for you. It's not lease. So you need to be able to draw the line of distinction between that. So how do we do it? What did IFRS 16 say about that? So as IFRS 16 talks about how you identifying a lease in a contract. It talks about how do we identify a lease in a contract. And the standard said that when you pick a contract, what you look for to know that there is a lease in there is that there must be something we call right of what? Of control. Right of control. And who will have this right of control? The person that is renting the assets. Whoever it is that wants to rent, not the original owner, but the person that wants to rent it. What we spot or look for is right of what? Control. That's how we identify a lease in a contract. That is, the lessee must have rights of control. Then the question becomes, what is right of control? You see, right of control means two things. It means two things. One is that the lessee or the person renting the assets must be the only one using the assets. Must be the only one doing what? Using the asset. And the second thing is that he must be able to use it the way he wants it. Of course, reasonable use, of course, but he should be able to use it anyhow he wants it. So how did the standard put it? He said, right of control means that one, the lessee must have right to obtain substantially all the economic benefits attributable to the leased asset. The lessee must have right to obtain substantially all the economic benefits attributable to the asset. What this simply means is that the lessee must be the only one using the asset. He must be the only one enjoying economic benefit from the asset at that point in time. Right? That's the first one. The second one is that the lessee must have right to direct the use the lessee must have rights to direct the use of the assets, meaning he should be able to use it anyhow he wants it. Should be able to use it anyhow he wants it. So, see, you must be able to state this in an exam if they should ask you. This is, it's not even this definition that really matters, right? What I need you to note here is that a lease must be a contract, right? And this is just saying that, okay, transferring from one person to another. But what is key is that how do you identify that there is a lease in a contract? And the key word there is right of control. And right of control means that the lessee must be the only one using the asset, which is demonstrated by him having able to obtain substantially all the economic benefit attributable to the asset. All. And the second one is that he must have right to direct the use of the assets. So you cannot enter a contract and you lease a truck and the supplier or the lessor is telling you that you can only move this truck between Aja and Lekki, right? If there's a restricted use like that, then you don't have right to direct the use. There must not be, if you are leasing a truck, you're able to use it anywhere in the country, right? Though a contract can state where you're supposed to use it for, that use it for this, it can state, but it should not restrict the use. like beyond a reasonable level, he cannot come back and say, no, you cannot use it for this again. He has to be, he has to give you the right to direct that use. The use you have agreed, right? You should be able to be the one dictating, not him coming and, right? So it's two ways. There could be an agreed way that you people have agreed you want to use it, but it should not be restrictive. One. Two, you might not have agreed. It might be an open arrangement. So what is key is that it must be the lessee that is directing the use of the asset. So we're going to look at some scenarios, right? And we would see if we can identify whether there is a lease in that contract. We'll look at that very soon. But before we look at that, okay, please.
Okay, sir. I was thinking, what's the place of okay? What's the place of time, duration in all of this? Because I am thinking all of this should be an agreement should be over a specified.
Okay, yes, you're very correct. And we are still going to get there. There's something we call lease term, right? Which I will get to in few seconds or in few minutes. Okay. So it's always, of course, for an agreed period of time, right? Mr. Umar.
Yes, sir. Under this lease contract, who is in charge of maintaining the assets?
Okay, so who is in charge of maintaining the assets? Really, it depends on the agreement now. It depends on the contract now. The standard didn't specify, unlike before. Things have changed. This is a new standard. So things have actually changed. Any of them can be in charge of maintaining or repairing. So they will have factored that in maybe the rent you'll be paying or in the lease rental you'll be paying periodically. Okay, so any of them, it depends on the contract, right? Okay, so we are going to address all of that. Okay, please.
My question is that the lease agreement. What I need to be clear is because you said lease is simply as hire purchase. Now, the lease agreement meaning that is it an agreement that the lessee will pay certain amount and after a period of time the asset become his own, or is it that he's going to be using the asset like rent but for a longer period? So I need to understand where that point.
Okay, so again, see now this standard is principle based, right? So it depends on the contract again. There are some contracts whereby they will tell you that you will become the owner at the end of the lease term. There are some that they will tell you that you have to return the assets. Okay, so this standard has changed everything. We don't really care. Why? Because of the way we are going to be accounting for it now. It has already taken care of that arrangement, which you are going to see very soon. So here it doesn't really matter whether it will become your own or whether it will not become your own. It doesn't affect the way we account for it, which is why I'm not really going in that direction yet. Okay, but we're still going to address all of this. Let's just continue. Now, having identified that there is a lease in a contract, another thing is that before you can even agree that there is a lease, it's not just this alone, right? Another one is that there must be an identified asset. There must be an identified asset. So, yes, in identifying a lease is right of control. In addition to right of control, which is this, there must be a what? An identified asset, which simply means that the asset, the asset must be specified in the contract. The assets must be specified in the contract, meaning that the supplier cannot tell you that, okay, you can lease any of my assets. Maybe the guy has many trucks. You now go there that you want to lease a truck. You're like, okay, you can take any of my truck whenever you want to. No, that is not a lease. Okay, the lease, in a lease arrangement, we must know the specific assets that we are leasing. And that is the one we're going to be accounting for very soon. That's one. The asset must be specified in the contract. Two is that the lessor or the vendor or supplier cannot substitute the asset, cannot substitute the asset unless for repairs and maintenance. The lessor or the vendor cannot substitute the assets unless for what? Repairs and maintenance. So this is about the identified assets. The asset must be specified in a contract, and the lessor or the vendor must not be able to substitute the asset. So you cannot rent an asset now, or lease an asset, or hire an asset. The vendor now comes after 2 months or 2 weeks and say, yeah, bring this one, let me give you another one. No. When you lease a specified asset or an identified asset, is that asset that has to be. So if there's an exchange of assets, that would automatically mean the end of the initial lease. It's like you are starting over a new lease. So the only scenario that the standard recognize where the supplier can substitute an asset is if there's a repairs and maintenance. So the agreement has said that, okay, the lessor will be the one that will be repairing and maintaining the asset. So the lessor can pick up the asset and give you another one, then he goes and repair it. Then when he completes his repairs, he brings it back to you. And that's the only scenario. Other than that, he cannot substitute the asset. So that is it about identifying assets. So in a question, this is how to identify a lease. One is right of control, and two is what? Identified asset. Now, the next thing that which he mentioned is a lease must have a what? A lease term. There is always a lease term in a lease. So, and this is usually the period over which the lessee has what? Has right of what? Of control. The period over which the lessee has right of control over the asset or on the asset. The period over which the lessee has right of control on the asset. That's the lease term. However, there is something tricky here because you see this period, this lease term can include this period can include something we call a period of extension. It can include a period of extension if it is favorable. If it is favorable for the lessee to extend it. What are we saying here? So a lease term is the period over which the lessee has right of control, and we say this period can include a period of extension. What we are saying here is this: if the lease term is, let's say, 5 years, they can always be in a contract that you can extend it, right? Can extend. So there's always a primary period and there can be a secondary period. So if the contract states that you can extend it by another 2 years, you right from the beginning, you must know the lease term because you need the lease term. So what will now be the lease term? Will it be 5 years? Will it be 2 years? See, there's already a conditional here that this lease term is only going to include period of extension if it is what? Favorable for the lessee to extend. So the question becomes, how would you know when it is favorable? In most questions you will see, they will tell you. In fact, in most of them, they will tell you that the lessee can extend, but it is not favorable for the lessee. It's not what? Favorable for the lessee. So you that you are in this class, you should already know that the lease term is going to be just 5 years. But if they tell you in the question that it is favorable for the lessee to extend, then you should know that it's going to be how many years? 7 years. Alternatively, they could give you in form of figures. So if the lease rental per annum is 100,000, and when you extend, they say you should come and be paying 1,000 naira per annum, without anybody telling you whether that's favorable or not. Is this favorable to the lessee? Yes, it's favorable to him. So in that case, the lease time is going to be how many years? It's going to be 7 years. Okay, so this is all about lease time, and lease is always over certain period of time. Okay, so that's the background knowledge. Now let's go to how do we account for leases?
For the 2 years extra,
Extension.
yeah, the extension. What if it's same amount with the 5 years? So
It's not favorable. It's not favorable because you have already used an asset for 5 years. The situation will not be the same. The situation is not going to be the same. So that's not favorable. So the lease time is going to be 5 years. Instead of paying the same amount, is it not better for the guy to go and enter into another contract? Enter
What if
into another
the asset
contract.
is more like say land? Probably there's no development or something at that point, and at the point after say a period of time, it has I won't say appreciated, but it's better.
Okay, so now in that situation now, IFRS is principle based. It's not left to the accountant to make his own judgment whether it's favorable or not, right? So if you are looking at a land now, the value doesn't really, um, yeah, if you are looking at it in that regard, it can still serve what is serving right from the initial. So you can judge that, yeah, this is favorable to me. But if I should go into another contract, maybe I'll now be paying 200,000 per annum, right? So it might be favorable. But for our exam purposes, right? So the most questions we have seen, if not all, they will tell you that, okay, this extension is favorable. This extension is not favorable. So it's you that will know that, if it is not favorable, that means I won't consider the what? Extension. That's what you need to know.
You said lease term is leases is just like hire purchase. The hire purchase that I know before is that when you default, they will take back what you maybe a vehicle, they will take back, they will not refund the money. So if somebody defaulted paying maybe the interest and the real money you're supposed to pay annually. So what will happen? Two, the period of extension that you are talking about, is it going to be at the inception of the contract, or is going to be for, or maybe the person cannot cope with the payment? Maybe it was meant for 5 years, so the person seek for the extension so that the person can be able to pay. I just want
Okay, that's a good question. So the first one is this: yes, if it defaults here too, they can retrieve the asset, even though the standard says that this lease term is a non-cancelable period, right? That's what the standard said. It said lease term is a non-cancelable period over which the lessee has right of control. But that does not apply in the case of default. Again, right? So because IFRS has tried to be principle based, right? Everything depends on your contract. is contract. Now, what we account for is substance, right? What is important for us, which you will see very soon, is just look for right of control. That's what is key. A lot of clauses, this is the one you are thinking about. You see some contract, you see a lot of things there. It doesn't really, what is key for accountant is there a right of control? Is there an identified? There could be a lot. He mentioned one that, okay, maybe at the end, they can say the asset becomes his own. And it doesn't affect how we account for it, right? So the guy that if he defaults, you collect back his asset. That one is that one is a no-brainer. Which obligation is it for first? They should have stated in the contract, right? It should be there in the contract because if the guy is not maintaining it and he's the one maintaining, then he will net off his money against, right? So judgment is required anyways, right? So if the contract has stated that you are the one that is supposed to maintain and you're not maintaining it, it's expected I will net it off from your yeah. So it's now left to the court to decide the the orders.
So the second one,
Okay, now the period of extension, what they are talking about there is not giving him an opportunity to pay. The period of extension is that the lease term has ended. He has fulfilled what he needs to fulfill. Then, but the guy still needs the assets. So we now extended the period, right?
is it going to be at the inception of the contract?
Again, in most contracts, it's going to be at the inception, but it's not written in the standard that it has to be at the inception. It depends on the contract. So there are some contracts that will say they will have been defined at the inception and you can extend, right? In most contracts, it will be there that you can extend. In some contracts, it will not be there. It is at the expiration. The guy will say, I want to extend, right? I want to extend, and you can extend. So it's flexible for us as accountants. What is important for us? What is important for us is right of control, and which you are going to see. That's what's important. So a lot of things that you can think about that can happen. In fact, there are some that they will have agreed in the contract that after 2 years, so I will increase it. Oh, yes, they will have agreed. They will have agreed a lot of things. Okay. Someone wanted to ask a question.
From the this the extension part and where you said whether the contract is when we look at the favorability. Now, if you're looking at favorability from the entity aspect, are we looking at it from the we are looking at what if there's a question where it is not clearly stated whether it is favorable or not, but they just give us a scenario where there's an economic benefit. And so as a result of that, so are we allowed to make judgment on that?
Yeah, I get what you're saying. Yeah, I get what you're saying. So again, yeah, there could be a question like that, but I doubt it's going to be here. So if there's a question that what the alternative way to telling you whether it's favorable or not is to give in terms of the rent he's paying, right? So like he suggested or him that you are paying 100,000 in the first 5 years, and then I say you can extend, but you still continue to pay 100,000, right? So again, that question is a bit tricky. But if it's me in the exam, I will easily say it's not favorable, right? I will easily say it's not favorable. But examiner doesn't want, they don't set question like that. No, they don't. Because they want to have a script and just mark it. They want to test principle. So they always tell you, for you to be able to remember that favorable or not favorable, that's what we're going to test as far as extension is concerned, right? So if we want to ask you questions on how to make judgments, we have other ways at which we are going to ask that. Not, no, 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 that's not what we want to test. More questions? Okay. Now, this is the background knowledge for leases. The first thing is that a lease has to be a contract. Majorly, it's transferring rights of use from one party to another in exchange for a consideration. And like he added, is always over a period of time, which we mentioned here. But even beyond that definition, what is important for us is how do you identify a lease? And you identify a lease firstly by knowing that the lessee has right of control. When the lessee has right of control, it means that he's the only one using the assets, resulting in where he obtains substantially all the economic benefit attributable to the asset. All, everything. The second one is he must have right to direct the use of the asset, meaning the use must not be restricted. He must be the one dictating the use. And you find out that in most contracts, they will have identified what you can use it for. So what we are saying is don't come back and restrict it. It should not be, the guy should be able to make decision about the use. Please.
If the lessee has the right of control,
Yeah.
can he also insure the assets?
Okay, so that's a very good question too. Again, it depends on the contract, right? IFRS didn't mention all of that. It must be this. That's rule based, right? So the contract will have stated who can insure the assets. There are some contract that will tell you that as soon as you lease this asset, go and insure it too. So in case of damage, and in some instances, to be the lessor that would insure it and be paying premium, right? So it depends, really. You can insure, the lessor can insure. The standard didn't mention who must insure. Good question, very good one. Okay, so in addition to identifying a lease in a contract, there must be an identified asset, meaning that we must be able to point to a specific asset, and the lessor or the supplier must not be able to substitute that asset unless for repairs and maintenance. Okay, you want to ask a question?
This liability you are talking about, is it the rental payment or the value of the asset entirely?
Good question. Is it the rental payment or the value of the asset? So let's look at two scenarios. So a scenario, I think that will be sufficient. You see, in most instances, when you enter a lease, the only cash flow that concerns us is the annual rental. So if you enter a lease for 5 years and you're supposed to pay 10,000 naira per annum, right? So we don't really care about the value of the assets. Nobody cares about that. What we are saying here is this: you have a liability equivalent to how much? 50,000. That's what we are saying. And it is that 50,000 you recognize as lease liability and also as what? Right of use assets. However, I don't know if I've told you this before, but I think I should have, that whenever we have a future payment, because this 10,000 naira per annum is not what we are paying now. It's something we are paying in a long time, the next 5 years, right? So we cannot enter 50,000 in our books. We don't recognize future value in the books. What we do is to get the current cost, or what we call the present value, right? So you have to discount this to present value. And since it's always equal annual payment, when you want to get the present value of equal annual payments, what do? You use the annuity formula. That's what you do. You use the annuity formula. You see, in an FR exam, except a poorly designed question, we don't care about the annuity formula, 1 minus 1 plus r raised to power. We don't really care about that. So in most of the questions you'll find, they will give you the annuity factor. They will give you. So it is now left for, in fact, they will even give you the present value. That's not what we are testing, right? They can give you the present value and they might not, right? So they might not be requiring you to do that formula, as the case may be. But if you know it, there's nothing wrong with that. So that is what you recognize as a lease liability and what? Right of use asset. So with that context again, let's take it one by one and let's see how it is put in the books. So let's start with the lease liability at the commencement date. Now, how much go to the lease liability? We said what you recognize is the present value of what? Of unpaid lease rentals. The present value of what? Why it is unpaid is that if, let's say, you are paying 10,000 naira for 5 years, okay? 10,000 naira for 5 years, and at the inception of the lease, you have already paid 10,000, or maybe you have paid 20,000 as down payment. So in that scenario now, the liability is not 10,000 over 5 years again. It's just 10,000 over how many years? Just 3 years. The three 10,000 naira remaining. Okay? So what we are concerned about is not the PV of the total lease rental, but the PV of the what? Unpaid lease rental. So while this one goes to liability, that means your liability will increase. When your liability increases, do you credit or debit? You credit. Where will the other leg go? Finance cost bow. Where will the other leg go? It goes to right of use assets. That's double entry. Okay? So the same amount here, the same amount here. So it's not difficult. You credit this, you debit this. With what? This amount. But I'm still coming here. I'm not done with this. This is just at the beginning of the year or at the commencement of the lease. What happens at the end of the year? So at the end of the year, now we have to look at two things now. And what we are looking at is, when was the lease rental paid? Majorly, you need to be paying your rent every year or every month, as the case may be. You need to know what is the timing, and there are two timings. So it's either he pays at the beginning of every year, or he pays at the end of every year. Okay, so let's consider the first one, where lease rental is paid at the end of every year. That is in arrears. This is what we call in arrears, where lease rental is paid at the end of every year. That is in arrears. So when lease rental is paid at the end of every year, so at the end of the year, the first thing you do at the end of the year is you are going to increase the lease liability with what? Interest, or what we call finance costs. That's the first thing you do. The second thing you do is you are going to decrease the lease liability with the annual lease rentals. And that's all that you do. This second one is very clear, because if you have recognized a liability of so much, that you are owing this so much amount, we expect that at the end of the year you start paying. That's why we are decreasing it with what? Lease rental. Then the core question becomes, why are we adding interest? Why are we adding interest? Why are we increasing it with interest or finance costs? Who can tell me that? Why are we adding interest? It's simple. You can look at it basically that he has borrowed money and he has to pay interest. Right? You can look at it like that. But the main reason is not that. The main reason is that whenever we discount to present value, whenever we what? Discount to present value, as you move through time, you have to unwind that discount. You have to do what? Unwind that discount. Because if you're supposed to pay 10,000 over 5 years, which is 50,000, if you discount it to present value today, it will be around maybe 42,000, depending on the discount rate. When you get to that future period, that amount should be 50K wherever you are keeping the account. And the way we do that in reporting to ensure that we take back as we move through time, the amount will increase. We do that with interest or finance cost. Okay, that's majorly why we are adding the interest. You find it in a lot of places as you continue your study, that whenever we get present value, whenever, anytime, we must unwind the discount. And the only way we do that is through interest or finance cost. That's the only way we do that. Okay? And that's why we are doing these two. Now, another thing is this. At the beginning of the year, for that lease rental, for that lease liability, we recognize the entire money we are supposed to pay. That this one we are owing it, which is true. We are actually owing it. So we recognize that as lease liability. And I've told you the two entries for that. That the first leg is a liability. I told you that the second leg will go to where? The assets. The right of use assets. So that one is cleared. Now, at the end of the year, we say that we are going to unwind the discount, or let's say we are just paying interest on the money we have borrowed. But the right thing is that we are unwinding the what? The discount with interest. Then my question to you is this. This one is increasing the lease liability. Without even me telling you, you know that means we are crediting the what? The lease liability. That's what it means. So that interest is increasing the lease liability. We credit it. There's always the second entry. Where would the second entry go? Where would the second entry go? Where would the second entry go? If the first entry for this interest or finance costs is increasing the lease liability, where would the second leg go? That's correct. It goes to POL. And you remember that portion in your POL after your operating profit or profit before interest and tax that you have finance cost. These are candidates for that. To just go there. Lease interest or interest on lease. You simply call it finance cost. That's where it goes. Fantastic. The second one, which is the lease rentals that we are paying per annum, the rent. They said that you would decrease the lease liability with this lease rental. When the liability is decreased, that means you are debiting the liability. When you are decreasing your what? You are debiting it. There's a second entry. There's a second entry. Where would that second entry go? Where would that second entry go? The lease rental we are paying per annum. Thank you very much. You credit your cash or your bank because that's the rent you're actually paying. I mean, it's important you know all of this, and that is everything. If the lease rental is paid in arrears, that's it. That's all. It's no more than that. Now let's look at the second dynamics, which is where the lease rental is paid at the beginning of every year. The second one, this one, just put lease rental. Lease rental. The second one, lease rental is paid at the beginning of every year. That is, in advance. In that scenario, the first thing you do is you are going to decrease the lease liability with lease rentals, and you are going to increase the lease liability with interest or what? Or finance costs. It's the same, just that the order has changed. And with this change in order, it's going to change everything. Look at this one. The first thing you do, this one remains sacrosanct. It doesn't change. The PV of unpaid lease rental at the beginning. But at the end of the year, if the lease rental is paid, they told us that they pay it at the beginning of every year. The first thing you do is to deduct that lease rental. You know, interest is always done at the end of every year. It's always done at the end of every year. That's why at the end of the year, we did the interest before we deducted this one, where the lease rental is paid at the end. But this one, since the lease rental will have been paid at the beginning, for that reason, we decrease the lease liability with the lease rental first. You see, when you do that, that means you now get a balance here. Is that balance you now calculate the what? The interest on. The interest you will get here will be different from the interest you will get here. Because here, you are calculating it on the opening before you deducted the lease rental. But here, you are calculating it on the balance after you have deducted the lease rental. They are not the same. They are different. So you need to be careful to know when the lease rental is being paid. And that is all for lessee accounting. That is all. It's no more than that. It's no more than this is just it. This is just it. But the question remains that what we are saying here is this. Whenever you rent an asset or hire an asset or lease an asset, you must immediately recognize a lease liability and a right of use asset. So for lease liability, this is it. So now let's quickly look at the right of use assets. Okay, and I've told you already that for the right of use assets, at the beginning, at commencement, where you credited this, when you increase your lease liability with the unpaid lease rental, the other leg will come where? Will come here. This is where the other leg comes to the assets. But it cannot end here for the assets. Because look at it. If let's say what you are paying is, let's say you are paying 100,000 over the lease term, let's say 10,000 over 10 years. And at the commencement date, you did a deposit of, let's say you did a deposit of how much? Let's say 30K. So that means you are supposed to pay how much over the lease term? 70. So by the time you get present value of this one, which is the unpaid lease rental, that is what comes here. Abi? And the other leg comes here. But that does not show the true picture of the assets. So to get the true picture of the asset, for us to get the true picture of the asset, we will need to consider this one that you have paid so that we can have the true picture. So in this right of use asset, you need to also consider the amount paid at when? This when, by the time you add this one now, that gives us the total value. While this liability deals with what we are owing, this one deals with the two. The one you have owed, the one you have paid. Then we know the entire what? Entire value. And that shows. But you know that it's possible that it's rare, but it's possible that the guy will tell you that, okay, pay 30K at commencement, but I'm giving you 5% off. You know, I'm giving you incentive for whatever reason. What do you do with that? You have to remove it. Less incentives received. If they tell you something like that, you have to remember to remove it. Okay, so this shows us the true position. But you know, when you have an asset, if you have to carry the asset from the supplier's office to your office, or maybe you have to get it ready, like all those directly attributable costs. If you have to incur that, any cost you incur to get the asset ready, we call it here initial direct costs is also added too. You add initial direct costs like site preparation, professional fees, initial delivery and installation or assembly, and all of those ones that we have mentioned. Initial direct costs, that is what they call it in IFRS 16. That is also added. And finally, what you can also add is, if you remember, initial estimate of dismantling, removal, and restoring the site to its initial condition. The same thing as we did in IFRS 16. If that is a condition here too, we have to consider that too. Okay? Just that they might not ask you that in IFRS 16, but if it's there, you consider it. But remember, I told you something, that initial estimate of dismantling, removal, is a future money you will pay. You need to bring it back to what? Present value. Okay? So, initial estimate of dismantling, removal, and what? restoration should be considered. So by the time you add all of this, that gives you the initial cost of the assets. That gives us the initial cost of the asset. What happens at the end of the year? Because this is just at commencement. What happens at the end of the year? So at the end of the year, what you simply do, if you remember, is either you are using a cost model or you are using a what? Or you are using a revaluation model. There's a third one that we have not mentioned before. There's another one called fair value model. All what these three means, what we are concerned about here is just to determine the annual what? Annual depreciation. Okay, so determine the annual depreciation either using cost model, revaluation model, or what? Fair value. You will learn very soon when we get to this, when we do this, that whenever we are using a fair value model, you don't depreciate the asset. You do not depreciate the assets. You will learn that very soon. What we have really learned is the cost model that makes use of the costs, and evaluation model where you have to be getting evaluation surplus and deficit and all of that. And all this helps us in determining depreciation. So you determine the annual depreciation. Now, the depreciation, the assets is depreciated. Is it over the lease term or over the useful life? Okay, so it's usually the lease term, but the standard says over the lower of the useful life and the what? The lease term. So we just consider the lower between the two, and we are going to depreciate it over that period. Okay, so that's what a lessee is expected to do whenever he enters into a lease arrangement. Finally, before we start our test, will it be in all cases he will have to do this? No, it won't be in all cases. It won't be in all cases. So there are two scenarios where he might not do this. So it's optional. He might do this, he might not. Meaning that he will not have to recognize lease liability, right of use asset. That all he does at the end of the year is just to recognize the rent he's paying and expense that. A credit bank, a debit POL with whatever rent is paying. Credit banks, debit POL. Credit bank, debit POL with lease rental. And that's the standard called optional exemption. Optional exemption from the application of this lessee accounting. Optional exemption. There are two optional exemptions. One is the lease term. The lease term is less than what? Than 1 year. So if you are entering a lease of 8 months or 9 months or 6 months, you don't have to do this because it's even difficult to discount in months. So if the lease term is less than 1 year, there is no need to do all of this. Just recognize the rent you are paying as expense, and that's it. Two, the asset is of low value. the asset is of low value. So if the asset is low, then you don't have to do all of this. Just expense the rent you are paying. And the definition of low should be clear to everybody, right? Everybody that looks at, irrespective of which company you're operating, is low. Like maybe you lease, let's say a printer, for example, now, right? Even if it's for 2 years, it's low value. Or you lease a laptop, it's low value. You don't have to be doing all this because of a printer or a laptop, right? It should be something material. That's where materiality comes in again. But now, this low value thing, they said, irrespective of, don't say, my company is huge. 50 million is small to us, so it's low value. No, 50 million, 50 million is not small. God will not make our currency get to that level where 50 million and become small. It's a problem. Right? So now, and these are the optional exemption standard is talking about. And this is everything for the C accounting. You see, naturally, the next thing now for us is first, we look at scenarios to explain how to identify a lease. We look at scenarios on it, and we look at few questions to solve on. It's very straightforward. You see, very, very straightforward to solve on this lessee accounting. And then when we are done with that, then we'll go to lessor accounting. Okay. Mm, let's start our test. Thank you.